This is the Authority Company podcast, conversations with leaders who are building the future. Hola, I'm Joe Pardavila, and today we're joined by Daniel Schlaepfer, founder of Select Vantage and author of the new book, Real Trading: Why Stock Markets Will Always Need a Human Touch. As algorithms, dark pools, high-frequency trading, and commission-free apps reshape the markets, Daniel makes the case that human traders still play a vital role in keeping markets honest, liquid, and fair. Today we'll talk about what real trading means, where technology falls short, and why trading is still a profession that depends on judgment, discipline, and the human touch. Daniel, welcome to the show. How are you?
Good, how are you?
I'm excellent. Thank you so much for joining me today. And I know we're going to get deep into the stock market here, but I want to talk to you because I've been recently seeing on my TikTok these financial experts bemoaning the idea of building wealth with real estate. And they're saying, no. The only way you could build wealth is through the stock market. What is your opinion on it? And this is not going to be one of those this is your advice and everything like that. But what is your take on the idea that basically the only way to build wealth these days for many people is going to be through the stock market? What's your take on that?
I think the only way to build long-term wealth through any asset investment is to find a high-quality investment and hold it as long as possible and take advantage of compound interest. That's pretty much it. It can be real estate, it could be stocks, it could be, it could be a lot of different things. But the key is what this generation in the last sort of 20 years has lost is patience. If you hold something and you let it compound and you get dividends and you reinvest them in, or you get rental income and you reinvest it, that's how it kind of works. I mean, if you look at the number one answer on the Forbes list of billionaires of what their investments are in, real estate is the number one thing listed. It's not stocks. I mean, people have individual companies, many of them inherited it, but if you take a look, it's real estate's the number one answer.
Interesting. Okay, cool. And let me ask you a dumb question. And prepare yourself. I'm going to ask a lot of them today, Daniel.
Sure. Yeah.
Compound interest. What does that mean?
So it's actually, what's kind of funny is compound interest. This is an interesting conversation. Is one of the hardest concepts for the human brain to actually understand. So, people will say to you, I remember when a chocolate bar was 5 cents and I can't believe now it's $2. Well, eventually it's going to go to $10, right? That's just what's going to happen. And the 5 cents will be long forgotten. Compound interest, actually, I tell people this and they think I'm crazy for saying it, but it's actually what keeps the rich rich and the poor poor. So rich people compound interest positively because they don't have any debts. They generally put it into investments, real estate, stocks, different things. And they'll get dividends. They'll get the revenues of the companies will compound. The stock prices will go up. The value of the apartment buildings will go up, or real estate holdings will go up. Poor people borrow money with a negative interest rate that also compounds. So if you owe 20% on your credit card and you only make the minimum payments, that number is always going to be going up, right? So it's actually what creates a complete spread of why rich people get richer, because they earn positive compound, and poor people keep getting more poor because they borrow at negative compound. But essentially, it's just the constant compounding. It's addition of the previous gains added to the investment.
It reminds me of there was this phrase thrown around. I'm sure you know better than I, that when during the times of the low interest rates, people were using this phrase, money is free. And essentially, that's what you're talking about. These people are borrowing money with very low interest, and they'll make the interest off the money they're getting, which is it's such an amazing life hack that, again, that's why the rich keep getting richer.
Well, that's called like a carry trade, right? Essentially, so you get and a lot of people I know that invest in hedge funds, and you'd think these people or are hedge fund managers, you'd think these people have no debts. When interest rates are low, they actually take out more debt than you would think in large amounts, because if you can borrow money at 2, 3, 4%, and your hedge fund's compounding the interest at between 15 and 20%, you might as well borrow all the money you can on your houses, your boats, your airplanes, your art, everything you can, and leave it in the hedge fund where it compounds at a much higher rate. It's just free money.
Wow, it's amazing. All right, so let's get into the idea of stock trading, and the name of the book is Real Trading, as I mentioned at the top. But why was now the time to write this book, Daniel? Because we keep hearing that the stock market will only go up. It's always going to go up. Obviously, there's black swan events like the pandemic and 08. But why was now the time for you to write this book?
Well, the funny thing about it is, and the timing worked out pretty well in terms of when it's going to be launched, given that there's a lot of hype in the stock market right now with SpaceX, Anthropic, OpenAI, all these companies. But the intention was not to put it out now. The intention was to put it out actually I think almost 6 to 9 months ago. But the issue is there was a few topics within the book that were current events, and some of those events were sort of changing, and we wanted to make sure that we had the right opinion and everything was correct in it before we published the book.
And you mentioned some of those AI companies, which I think for many people don't want to say this out loud, but like SpaceX is basically an AI company underneath all
Yeah.
the fancy rockets. There has been this talk of the AI bubble happening. As someone involved in the markets, how much does it concern you that that the stock market has become incredibly top heavy, and you're seeing that these companies, these tech companies, which really aren't making money, but they're bringing in a lot of money from investors. How much does that worry you?
I mean, it's concerning. I mean, I saw a stat this morning. It's funny timing of the question, but Amazon and SpaceX essentially have the same market cap. Amazon's revenue is 764 billion, and SpaceX is 18. So there's the irrationality of the market has never been bigger than it is now. You have, Elon Musk came out the other day saying he expects by 2031 he'll have 1 trillion in revenue. That means he'd have to compound his revenue at 220%. It's never going to happen, right? Like unless he's getting some kind of government contracts that we don't know about, they're going to fill the coffers. It's just not possible. All right, and you have to think that there's people are starting to throw out numbers that are just massive, even with the compounding. Not in the short term will you see it. There's a discussion that they think within 5 to 10 years, he's saying SpaceX will have a market cap of $30 trillion. I mean, that's just an enormous number. And it's just, if you start to think about how many companies out there right now, if SpaceX had a $30 trillion valuation, that would mean the economy's grown Apple to like a $45 trillion value. Like, it's just not going to happen, right?
I
It's
just don't. This is not a SpaceX podcast, but I just don't see where that. I mean, unless they plan on launching rockets like every day for the
yeah.
next 10 years, like where are they getting this money from? Again, let's sidebar that because we don't.
These topics, we talk about these topics. They're talked about in the book. I mean, it's talked about in some of the blogs that I've written too, about how the ease of access for retail investors to make investments, and I use this analogy all the time, is if you woke up one day and you had like a hideous growth on your arm, okay, and it looked really, really bad. You came downstairs, you opened up Google, and you asked, how do I cut this thing out of my arm? I mean, you could go into your kitchen, you could get a knife, and you could cut the thing out of your arm and probably figure it out. But you'd probably go see a doctor. And I think what people forget is that so many people now are investing, and I do see a bit of a lost generation here, because it's not really investing, it's just trading. And you see a lot of people go in and they are making decisions that they think they can do because the access is so easy. But in reality, there are professionals that are out there that are supposed to be managing these things for you and adding a little bit of discipline. But right now it's chaos. I mean, why are retail investors clamoring to get into stocks that the payback period on the investment is like 500 years? It doesn't make any sense.
Yeah, which flies in the face of like private equity when they're like, yeah, we want our money back in a year. So it is funny how much they can find patience. People can find patience in that for whatever reason. And you talk about the book. A big part of the book is the human factor of it. And as you know, Daniel, the human factor has pretty much been removed because you have these large organizations that essentially want to sort of put the power in people's hands. They have an app that they can look up their stocks and they could buy and trade and all that stuff. But you talk about the importance of the human touch. Tell me why you become an outlier in this space where everyone's just like, yeah, the technology is going to just do it all for you. But tell me about the human touch.
Well, look, when I took over the firm, I took over 15 years ago, and I turned it into what it is today. I was told even back then we would not need human traders. Algorithms and AI would overrun everything. And the business continues to grow. We continue to add traders. We continue to find a place for ourselves in the market. AI has become a big part of trading for other firms in the space, but there's always been a space for humans in trading, and just that definition of what they do may change over time. But if you take a look at the largest trading firms in the world that are employing lots of AI, it's still humans at the top that are making the judgment decisions on the judgment calls on how the capital is deployed, where it's going to be deployed, what the results, if the results make sense. We talk about in the book too, you can't just have a computer make decisions into the stock market and not have any repercussions for itself. So like if all of a sudden a computer goes out there and starts trading, an algorithm starts trading and makes mistakes and has issues where it breaks rules, and the SEC wants to speak to somebody or FINRA wants to speak to somebody, you can't just say, oh, here, go talk to my server over here. It made the decision, right? Somebody has to sit there and do it. And we've talked about also that there's a problem where you have compounding decisions. So if somebody goes out there and breaks a rule with one algorithm and the other algorithm sees it breaking the rule and it makes a decision based on the rule breaking, which breaks another rule, the second algorithm can't make the argument that it was because of the first algorithm. So, I mean, we're highly regulated in our business. We deal with the regulators all the time. If I answered the question, go take a look what my computer has to say about it, like I'd probably be in handcuffs, right? So you've got to be, there's many different facets of the industry where you'll always need humans in the space. And I just think that too many people think, oh, we can go, even our own firm. I have people in my own firm that say, oh, we're going to start to use AI for this and AI for this. I say, good luck. But like, if you want to go deploy this, I'm still going to ask you questions about what's going on here.
Yeah, no, it's funny too, Daniel, because I'm seeing a lot of the people in the AI space sort of backpedaling when they talk about the job replacement thing. They're like, oh, no, 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 it's not replacing jobs, it's replacing tasks. You're still going to need the humans. And this is a perfect example of like the regulators, they don't care about if it's the AI made the mistake. A human is going to be responsible ultimately. Do you think more people in the financial sectors are seeing that, where like, sure, you may want to streamline things and use these platforms to replace some of the manual labor that takes. But at the end of the day, a human is going to be responsible. And like you mentioned, you might end up in handcuffs if you put too much into letting the computer do the work for you.
Yeah, for sure. And I think, look, I think if you can even see it in the economic numbers. I mean, unemployment is going up and productivity is going up, which shows you that we're getting more productive using less people because technology is getting better, and that's just sort of society over time.
Sure.
And you'll have these corrections. You'll have corrections where people will end up losing their jobs and having to repurpose themselves and figure things out. And I think society has a big fear of that right now. But as a company, whether it's, I mean, I can say this sort of from all sectors. A friend of mine who taught me quite a bit about sort of the theories behind AI and how you have to worry about your company are, the first reaction from everybody is going to be, how do I make my company more efficient? So how do I replace all of the repetitive tasks with computers? And that's going to be the first step. And everybody's going to say, wow, I just saved, 20% or 30% on my labor costs because I did it. But the smarter companies are going to be the ones that say, okay, now how can I take this and use those people potentially to now grow my top line? It's not just about making yourself more efficient from an expense perspective, but then how do you make yourself better as a company? And the third thing he said, which everybody needs to look at, is if you don't take a look every sort of release of these new AI platforms of what is in that platform that can take your company to zero, you better be careful, because a lot of companies will ultimately go to zero because these technologies are getting better and better. So I think you if people don't have the mindset that we should be using this to make our companies better and bigger and more revenue, if you only focus on the mindset of cutting out the tasks, it's just the wrong way to look at it.
That's a great point. It actually kind of reminds me of like the early 2000s. Like you can almost compare it to the early 2000s when high speed internet and all these platforms came on board. It's like, it's not that people were replaced. They just got computers in every office, and they got
Yeah.
they got high speed internet, and it made the job easier. And again, didn't eliminate tasks, but it just kind of made the task faster. And hopefully that will be the case with AI, as opposed to this AI apocalypse that
Well, when you
many
when you and when
people.
you think about it, if you think about an office environment, sort of like even not even that long ago, maybe 20, 25 years ago, you would have those envelopes. I don't know if you remember this, that would go around the office with like the red string on them and the little red thing on the top, and it would have signatures, and everybody have to read the document inside, sign off they've read it, move it around the office. I mean, now we have email that does that, right? So I think back about those times years and years ago, how much more, I'm sitting in an Uber on the way to work, and I'm basically doing 25 of those envelopes on the way into the office, whereas I'd have to get there, they'd be sitting in my inbox on my desk before, and then they'd move to my outbox for somebody to pick up. So and when we had the internet come in, and we had high speed internet and all the computers coming back in the late 90s, unemployment still went up, and then it came all the way back down because we grew these businesses and grew these, and the same thing will happen now. You will have people will have to figure themselves out. Some people, Some people, quite frankly, the jobs are going to be made redundant. They will be eliminated. But people will eventually, humans adapt, and we'll find out new things to do with these people.
Excellent. Speaking of new things, you write about the old image of the trading floor is mostly gone. And when you talked about that in the book, I was immediately getting the scenes of Trading Places and Eddie Murphy and Dan Aykroyd. I know that was commodities trading, but
Yeah,
like this
same
idea of
thing.
like all these people, right, just all over the floor screaming at each other. Tell people now who are not on that floor, who they think of Wall Street as trading places. What does the modern market look like now instead?
So look, when I got not lucky, but when I started in the industry, I've been doing this now 23 or 24 years. I got lucky. I got to go see the New York Stock Exchange on one of the last major days that it was really full and traded. And I got shoved around in the pit and pushed around. I mean, now it's a studio for Fox and for CNBC. That's all it really is. And if you look at the trading posts, where you used to have one or two people trading each individual name, you now have one person monitoring a computer that trades 20 names. So it's really office space and more for nostalgia and the opening and the closing in the TV studio. I remember going to the trading floors at Goldman Sachs and Morgan Stanley when we were doing business with them and looking around, and there was, it felt like thousands, but probably hundreds and hundreds and hundreds of desks on these giant floors in New York, and people screaming at each other and phones going. What's interesting now is it's a lot of automation is used. You have a lot more engineers helping you out to do these things, so you're more efficient. And a lot of those traders that would sit in the pits and do this on a professional basis, they actually just sit in their homes. I mean, I think there was the Dumb Money movie came out, right? There's the whole story about the whatever the guy's name was, William Kitty, sitting at his home. And when my business, even pre-COVID, we have trading floors all around the world. We still do, but we have more and more people that have a demand to do this from their home. They don't really feel like they need a desk. The communication can all be done now via chat or via like a video call like this. Like we have people setting up virtual trading floors and doing things differently. But this isn't somebody in like a suit that takes their jacket off and at the end of the day takes their tie off and is like sweating through their shirt and going crazy. It's not the same thing anymore. It's literally, and this is also because the access and the costs have become quite easy. The retail investor in the late 90s was paying, $50 to $80 a trade to trade stock. The retail investor now trades for free. It's a huge difference, right? And they rules have changed that have made it even easier for access for the retail investor. And people are setting up computers at home and trading at home. The trading floor, what was once the trading floor, is now gone.
Yeah, and you talk about Dumb Money, the movie that was basically introduced to the mainstream, the idea of the meme stock. You talk about that as well. For folks who aren't really into this world, I mean, we all know what memes are, but tell me about the idea behind meme stocks. As for someone who's been in the industry for so long, that for something like the internet to memify the stock market must feel really weird to you. But explain what a meme stock is and tell me what your take is on it, because I think for the aforementioned SpaceX, some people consider it a meme stock for the very same reason. So tell me about that.
Well, look, the term meme stock really comes that the communication and the promotion of the stock amongst people is done with memes via Twitter and Reddit and Instagram and things like that. What has happened in the trading world, and this is really trading now, not investing again, is what we've seen is because information is 30 years ago, the information that Goldman Sachs would have and Morgan Stanley would have would be very, 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 very different than what a retail investor would have. They still have a competitive advantage, don't get me wrong, but information flows are so different and it's so much cheaper than it was and easier to get access to that gap has dropped quite significantly in terms of the information flow that can be got by individual investors. And what we're seeing is there are situations where a group of traders, individuals have got together, done some research, and realized that there is a systematic problem within a stock. So you might have too many people short the stock, too many people betting it's going to go down. And they have figured out through information sources that this doesn't look right. And then they go out on the internet. And look, if you went out and called 30 people and said, let's all go buy as much of this stock as possible and screw the other guy over, I'm pretty sure that's illegal. But if you go out and you put onto the internet a meme or a joke and say, hey, you're going to go do this, or diamond hands, we're going to go do this, and everybody goes and does it, it's very hard for the regulators to say this was like this was a a mob of people doing this together. This was, hey, they all came up with on their own opinion by looking what was up there. And what you're seeing these meme stocks really are situations where the little guy has identified that the big guy is in a bad trade and squeezes the big guy in the bad trade. And that's why everybody gets so excited, because it's not like it's not the little guy that you read in the headline that's getting screwed all the time. It's really the big guy. The problem is ultimately the little guy is the one that gets crushed also. We only hear the good stories, right? We don't hear the bad stories. I said, there's another analogy I use, that I said that if you opened up Wimbledon to every amateur in the world, you would only hear the stories of when an amateur beat a pro. You wouldn't hear the stories how the pro annihilated 99.9% of all the amateurs and the tournament was eventually won by a pro. I'm going to guess that the top 20 finishing places at Wimbledon would still all be pros, if not the top 50, right? And this is what happens. We only hear on the internet about the best trades and the winners. We don't really hear about the people that got completely crushed. And it's even the way the social media algorithms work. It's people don't sit there and look for the failures. They only look for the wins. So you get pushed all the positive news and not the negative news.
That's wild. You use this phrase in the book called real trading. What does real trading mean to you?
Oh, that's a long answer. So there has been and we try to talk about them in the book as much as possible. There have been massive changes to the stock market over time, massive ones. And there was a massive one in 2005. They called it Reg NMS, that changed the way we will trade on the stock market sort of forever. And actually just this week, some of those rules were changed and pulled back. But the system is now built for computers to essentially do a lot of the trading. So this is why we talk about humans versus computers. They do the vast majority of it. And the retail investor is being told that they are better off because you have these computers of these massive firms that can sit there and give you an instant quote in the trade. But I asked the industry to take a look and ask themselves, you look at some of the very violent moves we have had in the stock market over the last several years. When everything's fine, it does appear that these people are getting good fills and it makes sense. When everything is not fine, we are seeing massive distortions in the market that in the end disadvantage the retail investor. The Main Street people are the ones that generally lose. They get stopped out. They don't understand what's going on. The other thing, if you went and talked to 90% of the people on the street, if not more, and I said, okay, you're going to go buy, Ford, the company Ford, you would assume that the person calls it a broker or hits a button on their Robinhood account and the order goes to the New York Stock Exchange to buy Ford on the New York Stock Exchange. Currently, less than half the transactions that occur actually go to the actual exchange to have the trading done. You are sending the order to get that free fill. You become the product of this. You send the order to a large company, a Citadel, Hudson River, Jane Street. There's a whole bunch of these massive companies. If you look at their P&L, some of these companies are putting up numbers like 16 billion in revenue a quarter, right? Private companies, like massive numbers. And they try to make the argument that what they will go to a Robinhood or they will go to an Ameritrade and they will say, okay, we will write you a check, and instead of sending your orders to this stock exchange, you send them to us and we will fill them to your customers as if it was done on the New York Stock Exchange. And it's done sort of in a mirrored, opaque way. One, I don't think most of Main Street understands that. Two, there's no such thing as a free lunch. If you're getting a free trade and Robinhood's getting paid for it, you have become the product, not the other way around. And I think that people need to understand that this may not be the best. Another analogy we use is, so they'll have you believe that if they can buy all of the orders from a Robinhood, that they can provide the best service. So I say to you this, Joe, if you were going to go sell a painting, okay, and let's say you pick Christie's as an auction house to go sell a painting.
Okay.
Would you want Christie's to fill the room and fill the internet with as many people possible to bid on your painting? Or do you think that you could get the best price if it was just one?
Yeah, it's pretty easy answer. I want as many people as possible.
So how can these large trading companies try to convince us that the best situation is that there's only one person to do it and they will do it the best way. And it doesn't add up, right? So there's been a change in recently where one of the large banks in the US, Wells Fargo, actually from where you're sitting, basically said, look, we're going to start to reopen this and start to not send our retail orders to these individuals and maybe start opening up to 2, 3, 4, 5, 10 of these people at a time and see what the numbers are like. And the early numbers are showing that it's better to have more people in the room than it is one, which I thought was pretty obvious the entire time. But I think the stock market has become so complex, and it's become complex on purpose. I mean, the harder it gets, the more you rely on other people. And what basically these Ameritrades, Robinhoods, what these people are saying to you is, don't worry about it. Because you don't have to pay anything for it, we'll handle it for you and we'll take care of it. One of the largest retail brokers in the world, Interactive Brokers, I think they are the largest. They actually have two options. They have, hey, you can go ahead and use the free stuff, or you can go ahead and use the way it really works. And you can get to understand the plumbing of how the stock market works, and you can do it this way or you can do it that way. And they give you two options on how to do it. And they try to educate their customers that this is something that they should understand. And I think, especially if you're doing trading and not investing, which most of these people are doing, it's important that you understand the plumbing and the mechanics of how these exchanges are working, because you're leaving a lot of money on the table.
I get what you're saying by real trading without all that BS in the middle, and without getting too caught up in this little rabbit hole here. Why do what is the value of those companies of buying those trades from a Robinhood? What are they getting out of it? Because I'm trying to figure out, like, does the math here? If they're paying for these trades, where are they making their money? Is there an easy explanation for that?
Yeah, so they're saving more on the way that they trade the trade than they're paying out, step one.
Okay.
Step two, the more information that they can acquire by buying these trades, if you think about it, they're basically buying information. They're buying and they can see. So if they buy it from this company and that company and this company, some of these firms, there's not a lot of them, but I think on last statistics, Citadel is on one side of 26% of all stock transactions in the US. That's an enormous amount of information.
Yeah.
And there's no coincidence that their hedge fund does extremely well. Their trading firm has never had I don't think it ever has a down day. And they're buying information. Like, if they can write that check in massive amounts to buy this, you have to think about how much they're making. During the hearings in Washington, and this was a part of the movie Dumb Money as well, the head of Citadel at one point even said, hey, look, we can cut the spread on stock trading in half and we'd be fine with that. Essentially saying you could cut our margins in half and we'd be fine with that. Right. And people didn't really notice the nuance of it. They were like, you know what? It's going to be cut probably at some point, but maybe we go from 1 penny to a half a penny. And it just sort of showed that's how much money they're making.
Wow. Well, good. Thank you for indulging me on that. That's because it's pretty fascinating. Because when you explain it to me, you almost describe it as almost like the Facebookification of Wall Street, because Facebook doesn't charge you for anything, but they're glomming all this information and then selling it to other people. So it's very weird. It's like it's hard for me to grasp, but you really explain it very, very easily. So thank you for that. Dan, I want to end on an optimistic note. After writing this book, what do you hope regulators, retail traders, and professional firms each understand differently about the future of trading?
I think we have to ask ourselves as a group, and I put all of those people in the same group, what are we trying to achieve here? So what is, by giving people access, one thing I say is a retail investor can open an options trading account 2 weeks faster than I can, a month faster than I can. And we have compliance staff. I have multiple licenses in this, lots of degrees in this, and they want to see that I have all kinds of proficiency to be able to trade US options. I think a retail investor can open in like 24 hours by clicking a few things online. And then they can make bets in which their money goes to zero overnight. And you can do it at probably 19 years old. So I think what we need to do is, what are we trying to achieve? Is the system achieving what we're trying to achieve? And giving people access. COVID did a number on people, because everybody was sitting around trading. Everybody became an expert. The amount of influencers on all these platforms went through the roof. And because people can have access, they're sitting there trying to make money now. And is that what we're trying to achieve? If that's what we're trying to achieve, then fine. And if that's what the regulators and everybody believe, we're just trying to give people access. Society has started to look at trading, and because it's stocks and because you can research it and because there's Wall Street, you're masking a gambling problem, right? If everybody was betting on NFL football every day, I think the government would step in. This isn't much different what these people are doing. These binary bets, the 0-day options. This is just literally a legalized casino that everybody has access to, and they're making bets. And there you will see a lost generation of wealth. I mean, hopefully a lot of these people will get inheritance from their parents in one generation, but there is a lost generation of wealth, and the future does not look great for some of the stuff. So I think what the regulators are we trying to achieve? Are we achieving what we're trying to achieve? And should we have given everybody this much access for such a low price?
Excellent. You can read all about it in Real Trading, Why Stock Markets Always Need a Human Touch. He's Daniel Schlaepfer. Daniel, thanks so much for your time. I really appreciate it.
Thanks for having me, Joe. I appreciate it. Have a great day.
And that's going to do it for this episode. If you want to find out more information about Daniel and our other amazing authors, go to theauthoritycompany.com.